Hi, I'm Steve Taddie, Chief Economist with HoyleCohen Wealth Management. I'm going to take you through our outlook for both the economy and the markets. And to do that, I'm going to use a few slides, one to give an overview and then a couple more to dig into the details. So with that, let's get started. Two key points for the economy. One, the economic activity for us is driven by the employed consumer. Now, while the first quarter GDP number of 1.6% might have seemed a bit anemic as compared to the 2.5% to 3% expectations, there was a mismatch between imports and exports that shaved a lot off that GDP number. Typically, imports and exports get revised a couple times, so expect in the upcoming revisions to the GDP report that that number gets revised and possibly we see a higher GDP number for the first quarter. Other measures of economic activity, more specifically consumption-based, show activity much more in line with expectations. Secondly, price levels from here are sticky. Yes, we had a lot of price inflation in both goods and services, but we expect these price levels to stick. And we find ourselves needing to grow into these price levels, much like a toddler grows into the next size up pants that grandma and pop have bought them for their last birthday. We're going to cover the Fed funds rate. We're going to cover it with respect to inflation measures, the higher for longer concept, yield curve, and also stock market valuations. Fed funds rate is above the inflation rates. You can see in the graph 5.25%, 5.5% Fed funds rate as compared to CPI, PPI, and PCE rates. It's that cushion that allows the Fed to follow inflation lower. It allows them to lower rates. But it's those most recent 3-month reads on inflation that we talked about that has pushed out the timing of the Fed rate cut. We have revised our view as well, and our revised forecast is for 3 to 4 rate cuts in the next 12 months, probably 1 or 2 in 2024. Remember, in the next 6-7 months, we have an election to contend with, and then in 2025, probably 1 or 2 cuts in the first 4 months of 2025. The higher for longer concept that we're dealing with, and it's in the headlines right now, not a new concept. This Fed has held rates at this level for 8 months, soon to be 9 or 10. And Bernanke's Fed held rates at a high level for 15 months. Burns's Fed in the 1970s wished they had. The chart to your right compares the inflation rate with the Fed funds rate. And what you can see is right about here, the Fed lowered rates, inflation kept going, so they raised rates to try and catch up and then cut rates too soon, too far, and held rates low for too long, and inflation came roaring back in the late 70s. We all remember that period, and it was Volcker who had to crush the economy to crush the inflation rate. This Fed views the cause of inflation to be self-resolving and now mostly resolved supply-side shock, not requiring an induced recession. And in fact, in today's talk, his testimony after the Fed rate decision, he made the comment again that it's not about destroying jobs. I paraphrase what he said, but that's the bottom line. So this higher for longer concept may be the best medicine to avoid a nasty case of deja vu of the 70s. The yield curve. This can be a confusing concept for a lot of people, but let's just break it down to what it is. The yield curve is a picture of what interest rate you can get based on the maturity of bond you want to buy. In this case, 2 years ago, a 3-month US Treasury yielded about 0.25%, a 30-year yielding Treasury yielded about 3%. Since that time, the curve has shifted upwards, and as of today here, has inverted, which means that short-term rates are paying more interest than longer-term rates, which is typically an anomaly. So if we're in a position where the Fed is saying, and economists are saying that they will lower the Fed funds rate, and the question is when, then the answer is when that happens, not if, but when it happens, this yield curve becomes flatter. Short-term rates drop, then they drop below longer-term rates, and you get to what's called a normalized yield curve, where you're getting paid to take the risk of inflation with a longer maturity bond. Now, this move from normal but low to inverted was significant, and you felt its effect in the declining price of your bonds. The yields you purchased remained the same. That was a given. But the price of those bonds in comparison to other bonds, it went down. This time around, when short-term rates drop, it will be just as significant, except this time around, it will be the income that you receive per year getting cut. And to one spending the income from their bonds, that can be pretty significant. So that is something to be on the alert for. If you've crowded into the short end of the yield curve, it might be time to look further out in the yield curve to keep these higher levels of income in your portfolio, as opposed to transitioning to lower rates when you roll over those shorter term securities. On the stock market valuation trends, it's been a good market. This last downturn, the market still leaves the S&P 500 a bit elevated over its longer term average. What's keeping the stock market valuation levels high is the expectation that earnings per share growth comes in at about 10.5% to 14.2% over the next 2 years, respectively. And at the core of those expectations for rising earnings per share is productivity and margin enhancements. That's at the core of most everything that's revolving around the stock market in the US. So looking forward, if I had to keep my eye on a couple things, one would be CPI, is that's going to drive Fed activity. And the second is productivity, is that is going to drive the earnings per share of the companies that we invest in. So that's what I have for now. I hope the rest of your day treats you well, and thanks for tuning in.